Hi, I'm Jim Richter with Monetell Advisors. We're coming to you from the floor of the CME Group. It's Friday afternoon, September 16th. The sell-off in the bond market that began 2 weeks ago was full steam ahead this week, mostly on the long end of the curve. If you look at where we started the month to where we are today, the 20 and 30-year parts of the curve are up close to 25 basis points. To put that in context, if you had owned the long bond going into the end of August, you'd be down close to 5% on the month. Very painful for a bond that was only pushing out a 2 1/4 coupon. One of the things that we find a little bit confusing about the bond market right now is the market's reaction to economic releases. Yesterday was a good example. We had economic releases in the morning that were across the board pretty weak. Generally, that's good for bonds because it lowers expectations of the Fed raising short-term interest rates. Well, it did help the equity markets. It did very little for the bond market, and actually the long end of the curve continued to move up in yield, down in price. Next week, big week for bonds as the September FOMC meeting takes place. Nobody really knows which way they're going to vote. We can say this one thing with confidence. The last thing they want to do is surprise the market. If they surprise the market, they create additional economic uncertainty. Economic uncertainty creates adds to the risk premium that capital needs to get put in place. Ultimately, that's bad for the economy. On the day, 5s and 10s are flat. The 10-year note is flat, trading at a 169 yield, and the long bond is up 13 ticks, trading at a 245 yield. From the floor of the CME Group with Monetell Advisors, I'm Jim Richter. Have a great weekend.